the profit motive. What does it mean? The whole purpose of a business is to make a profit. So the owner wants to increase his profit and make the highest possible amount that he can, because he invests capital in the business. So he provides the capital that they use to open this business and to expand this business. So he wants income out of this investment in the business. Now remember that capital is divided between own capital and borrowed capital. So own capital is the capital that the owner provides for the business. If the owner does not have enough money to provide all the capital that's needed in the business, then they will also use borrowed capital, and on the borrowed capital they have to pay interest to the financial institution where they borrowed the money. So the owner will start this business with the purpose of making a profit. Now say for instance we sell goods for 100,000 and my cost of sales is 40,000. Then it means that the difference between the sales price and the cost of sales is my gross profit. But that's not the amount that the owner will get, because there's a lot of other income and expenses that must also be taken into account. So I have, for instance, rent for 20,000 and I've got commission for 10,000. So it means the total amount that we have available in the business is 30,000. But now we have to pay expenses, and then I pay expenses for water and electricity and telephone, stationery, salaries, and all my expenses together is, for instance, 50,000. If I subtract that from my income, then it means that my net profit will be 40,000. So you must understand what is the difference between the gross profit and the net profit. Gross profit is where you take your sales minus cost of sales, and that gives me the gross profit. So it's only the difference between the cost price and the sales price. That is not the amount that the owner will get. Then we add all the other income, subtract the expenses, and the amount that's left over is the amount that the owner is entitled to receive. So that is my net profit. Okay. The net profit goes to the owner because he provided the capital and he worked in the business to make this profit. So the owner wants this profit to be as high as possible. So we have to work out what is the return on investment. That means how much percentage profit did he make on the money that he invested in the business. So I take this net profit there, the 40,000, and I divide it, for instance, with the capital that he contributed, 100,000, and then I calculate what is the total amount that he made. So he made a profit of 40% on his investment. That means he is making a very high profit, and it's worthwhile carrying on with this business because he will not receive 40% on any other investment. Say for instance, when you calculate this percentage, the percentage is 5%. And I can get on an investment at a bank. So if I put money in a fixed deposit, I can earn 7%. Then it's not worth carrying on with this business, because if I invest it in the bank, I make more money than I make with having this business. And with a business, you have the risk that the business can go insolvent, that you can lose the money, where with a bank you've got that fixed 7%. So the whole purpose of calculating this return on investment is for the owner to decide, is it worth carrying on with this business is the profit that I make high enough for the risk that I'm taking to provide the capital to the business?